Hi, greetings of the day. This is Professor Ramakrishna. I am Professor of Finance at AICSB Accredited School in India. And this is my YouTube channel, RK Varsity. Using this channel, I share my knowledge in financial accounting with students like you across the world. In this lecture, I am going to explain you the concept of liabilities and their classification. In my previous lecture, I explained you 5 key words around which all the financial accounting revolves. That is, one is assets, liabilities, equity, revenue, and expenses. So this is the second lecture in this series, which explains you about classification of liabilities. So I'll take you to my OneNote where I have a PDF and a real-time company's balance sheet with a different classification of liabilities. I'll show you all those to you now. When we talk about liabilities, so these are what the business owe to the outsiders. In a sense, what a business assets are what business own, whereas liabilities are what business owe. In a sense, this has to be paid to externals to the business. Maybe this has to be paid to the owners or to the outside creditors who sourced the funds to us. So liabilities broadly classified into fixed liabilities and other liabilities. When you're talking about fixed liabilities, this is about the owner's equity. So when you're talking about owner's equity, this amount belongs to the owners who provided funds to start this company or entity. So according to one of the rules of a business, once a business is legally formed, then it differentiates itself from the owners. So owners will be different and the company will be different, or a business will be different. So that is the reason why any amount paid to be owners, in the sense the capital provided by the owners in the form of equity or preference shares or the profits, are shown as a owner's liability in a liability side of the balance sheet of a company. Now coming to the liabilities, we have a long-term liabilities and current liabilities. So to differentiate the long-term liabilities and current liabilities is that any liability which is due for a payment within a 12 months, that is due for payment in less than 12 months, we call this as a current liability. So that means, suppose if you have to pay outstanding rent, that is for the financial year, 1 month or 2 months you have not paid the rent, so this has to be paid immediately in the following month. So this is your current liability. Or you purchased goods on a credit and you have to pay to your creditors. So this is again an example of your current liability. On the other side, long-term liabilities are of a which is having for which the payment is due above 12 months or more than 1 year. Suppose you borrowed a term loan from a bank, let us say a term loan for 5 years. So this is a loan which has to be paid in the next 5 years. So this is a long-term liability. Suppose if a company issues bonds, so this is again a long-term liability. So this is the classification or differentiation between current and non-current is that we have to see when is that the payment is going to be made, within a 12 months or after that. So based on that, we will decide whether this is a long-term liability or a short-term liability. On the other hand, we have a contingency liabilities, or these contingent liabilities may occur or may not occur. So simply may not occur. So here what is that we are doing is we are creating a contingent, or simply we are creating a provision. So provision foreseeing that some unforeseen things may happen in future, because of which we may have to pay this amount. Suppose we file a case against a company, and then we may incur legal charges for that. Or we sold the goods, but there is a possibility that some of the goods may return back. So for such cases, we create a provision. Also, we may not know exactly how much of tax actually paid. We paid some tax, but we are not sure whether that amount is sufficient or not. So in that case also we create a provision for a contingent tax provision. So any provisions that we create to pay when unforeseen events that is going to happen in future time period, they are called as a contingent liabilities. So these are the three broad classifications, that is a long-term liabilities, current liabilities, and contingent liabilities. When it comes to the equity, that is a fixed liability, this is the owner's equity. Now just I'll take you to real-time company's annual report. This is the Hindustan Petroleum Corporation Limited, one of the India's leading gas station or petrol distribution company. So here we can see that from a balance sheet, we can see the liabilities, so equity and liabilities. So you have a equity share capital, then other equity. So other equity, maybe your profit, retained earnings, or premium amount received, all those falls under the category of other equity. So you have total equity. When it comes to non-current liabilities, you have financial liabilities, importantly borrowings and other financial liabilities. So provisions, deferred tax liabilities, and other non-current liabilities. So these are the examples of a non-current liabilities. When it comes to the current liabilities, so we have again financial liabilities, borrowings, but however these borrowings need to be repaid within 12 months. So that is the reason why we classify these as a current liabilities. So trade payables to your micro enterprises and small enterprises, or dues creditor other than a micro and small enterprises, all these amounts that we need to pay within a 12 months. That is the reason why we place these in under the head of a current liabilities. So here we also have a provisions, which is nature of a contingent liability. We are not sure whether this provision has to be paid or not. So current tax liabilities that we have to pay. So these are all examples of our current liabilities. So if we go more in depth into it, so borrowings, when you're talking about a long-term borrowings, so here we have a unsecured loans in the form of a foreign currency bonds, non-convertible debentures. So these are the different types of borrowings for a long term. Then you have a term loans, so oil industry development board, that is a secured loan borrowed from oil industry development board, and unsecured loan borrowed from a syndicate bank and other foreign banks. Then other unsecured loans like a lease liabilities, and borrowings also we have a loans repayable on a demand secured from, these are all what you mean say is these are all current liabilities. So cash credit which you borrowed, you have to pay, tripartite repos, clean loans, short-term loans. So all these borrowings need to be repaid within 12 months. So these are the current liabilities. Now other financial liabilities, here we have a long-term borrowings, lease liabilities, then interest incurred but not due, unpaid dividends. So these are all examples of other financial liabilities. So I guess with this understanding, or with this real-time balance sheet, you will be able to appreciate what are the different types of liabilities. Like you have a fixed liability, that is equity. Then you have a non-current liabilities, which are of a long term, which you have to pay anything about 12 months, 1 year or more. Then you have a current liabilities, which are due to be paid within 12 months. Then you have a contingent liabilities like provisions, etc. So these are different classifications of liabilities. And my next lecture, I am going to introduce you to the revenue aspect. Now by this time we covered 3 topics. One is assets, then liabilities, then owner's equity. In next lecture, I am going to explain you about the revenues, and in another lecture about the expenses. So keep watching. Please follow the other videos also. Hope this will help you in enhancing your financial accounting knowledge. Thank you for watching the lecture.